Marketing firm Scangroup posted a 96% jump in half-year pre-tax profit, buoyed by strong advertising sales. The listed communications and marketing firm said pre-tax profit for the first 6 months of the year climbed to 520 million shillings, and that's thanks to a 70% jump in billings. Earnings per share rose 45% to 1.07 shillings, while revenue climbed 87% to 1.5 billion shillings. Earlier today, I spoke to the company's CEO, Bharat Thakrar, and asked him about the Ogilvy Africa acquisition.
I think what's happened is, just go back, why did we do the transaction with Ogilvy? The reason we did the transaction with Ogilvy was because they had an infrastructure, they had minority stakes in about 8 countries in sub-Saharan Africa. And 2 things happened to us last year. We took over the Ogilvy network and we won the Airtel advertising account across 16 countries in sub-Saharan Africa. So both those things obviously happened more or less at the same time, and that is obviously where the numbers have significantly changed for us. We took the infrastructure, and we had a big piece of business that we could park on the infrastructure almost straight away. And this is obviously the result of both of these fairly significant events that took place kind of in October last year.
But of course, on the back of that acquisition, we saw much fear that it would give Scangroup the muscle to dictate prices in the current market environment and lock out some of the smaller players in the market as well. What kind of pricing environment are we amidst at this stage?
I think you must realize that our business is not price sensitive in that respect. Our pricing is not based on whether we have a competitive advantage or not, against our competitors. It's pure and simple based on what infrastructure we have, what are the resources that we have, the quality of resources we have. Clients will give us a scope of activity. We will then agree a fee that's required to deliver that scope of activity, and this is how we get paid. So it's not in terms of are we offering a better price advantage because we have weaker or low competition.
At this stage, we've got the company poised to make 4 more acquisitions over the next 3 years, and that across the African continent, and that in a bid to open up and diversify your revenue base. Any detail on what we're potentially looking out for there? Because we know that it's a venture towards the west of the continent. What kind of competitive landscape are you entering?
I think the competitive landscape is not the issue. The issue for us is that we are acquiring businesses, or we intend to acquire businesses in the other markets where our clients would like us to be present. The reason they want us to be present there is the current skill sets that are available in these markets are not what the clients would expect. So what they are expecting us to do is to go into those markets, find reasonably decent, strong partners, and then build capability and capacity with these partners so that we can deliver global best practices to our clients.
Looking at these expansion plans, is that part of the rationale behind the company not recommending a dividend this time round? And when could investors be expecting to see a resumption?
Absolutely, you're right. We need the cash at the moment. We are on an acquisition mode at the moment. The intention is for us to take 51 controlling stake in the markets that we would like to enter into. We are currently in negotiation in about 4 different countries with local partners to try and go to a controlling situation where we have 51. And again, going back to what I said just now, the intentions are obviously, the reason we do that is so we can build capacity and capability in these local partners so that we can offer our clients global best practices.